Good morning, traders and investors. It's Tuesday, April 15th. Today, I'm going to touch on the weekly charts and the major trend at play with the SP 500. I want to zoom into the 30-minute chart with an update of some interesting charts that I find are very powerful to keep you in tune with the markets and see these games that the institutional players are doing with the short-term price action to make you think the markets are moving higher and they're strong when it's actually doing the exact opposite. I want to touch on gold weekly levels, daily levels, where to put a potential stop or an area to get out. We've had lots of people wondering, if you're long gold and you're in it for a trade only, where do you want to get out if it starts to reverse? Again, I'm a big believer gold long term, but I do believe it will eventually have a pullback and correction, and there'll be a better opportunity down the road. I want to touch on gold miners, silver miners, the 10 and 30-year yields, and also TLT weekly chart. So let's just jump into the markets. Now, there's a big misconception about diversification. I've touched on this many times. If you take a look at these indices here, we've got all the way through the US to Nikkei, the Euro stocks, the DAX. The biggest thing to understand, guys, is stocks are stocks. It doesn't matter if it's a micro cap or a mega cap. It's a stock in the stock market, and when the stock market tide is going down, it pulls all stocks down. Now, lots of people were saying they're moving over to the DAX, they're moving overseas to get stocks because the market was holding up better than the U.S. markets. As the DAX was moving up and trading sideways, the U.S. market was moving down and sideways. But as you can see here, when panic selling hits, look at the hard right edge of these charts. They all do the same thing. Stock is a stock. It doesn't matter how diversified you are. You may just see a bit of a delay before you get hit, but you will get smoked in a bear market. That is just how it works. So that is what we do, is we rotate from asset class to asset class, not from one pocket of stocks to another, but from stocks to something else that will benefit. So with that said, let's jump into the weekly charts of the market here. If we take a look at the let's go to the weekly chart of the SP 500. We'll go to the futures chart here. If we go to the futures chart, this is the weekly. I want to show a few things. So more or less, we had the COVID lows. We had this big rally up and this big push, which we took advantage of. Now, if we were to just use a Fibonacci retracement, we can see this level as it started to pull back, and we had the mini bear market through 2022. We could get a gauge with Fibonacci retracement of where that level should retrace down to. And the sweet spot is between the 38 and 50% retracement. If it pulls back and finds support in that area, it generally is a fairly strong sign that the market wants to move higher. Now, after that started to happen, we could project where, with Fibonacci extensions, which shows us where it should go next, to the upside, based off this low, to the upside, you can see we came all the way up to the 618, which we had a hiccup there, and then we did a double or triple top here on the weekly chart, and now we've got big selling coming in. Now, the markets were pointing to this. The technicals were pointing to this. Eventually, there was a piece of news that helped really trigger and make it happen, but I do believe the market was set to top. Everything was falling apart, very similar to over here, back over here as well. And usually there's something that might create that tipping point that'll take the blame. Tariffs is definitely taking that this time around. Now, overall, we've had a very strong pullback in price, and now it is bouncing off the 150-day moving average and trying to figure out where it is going. Now, if we drop down to the daily chart, we can come forward here and just take a look at the price action. We can be, okay, well, from this high down to this low, and this high we can see here, the Fibonacci measured move, we've come down, we've blown through this 100% measured move. Now, there was massive volatility, huge panic, which is why it's washed out through here. It's also why we have massive volume. And now the market has hit this downside move. It's having a bounce. So now we need to gauge where price could go. We could actually, this is the daily chart. We could look at the very near term and say, okay, well, based on this low and this high and this pullback, we could actually gauge forward where we could see this market want to push forward to, which at this point today, which is the markets are down a little bit in pre-market, we could see about a 7-8% move, which will bring us right into these highs, right into this breakdown low, and of course into this pivot area, which will act as resistance. So there is potential here for still a continuation bounce. a dead cat bounce. It might drag out over, it could only take a week. It could drag out over several months. Again, we're not trying to pick a bottom. We're not trying to play the upside. We're going to let this bounce. And then if it starts to roll over, that could generate a new trigger for us to move into a different asset or take advantage of falling pricing, depending on how all this unfolds. So that is the bigger picture on the daily chart. But now let's jump over to the 30-minute chart. This is a chart that obviously a lot of you like to follow. It tells us where we have these short sell triggers in the market. It's hard to see here, but SS short sells and moves to the downside. We have another short sell triggering yesterday at the open. This is a short-term momentum strategy. We had FOMO buying, and typically when we have FOMO, which is really dwarfed with this huge wave of FOMO, whenever we have these waves of FOMO and overbought market conditions, the market tends to want to pull back. We had short sell signal, FOMO happening, and we'll see if the market has a bit more volatility today. Yesterday morning's post to members, there was a lot of great comments, but there was a comment here that's worth freezing this video and just reading this over or going to visit it. This is a comment from a member, and he really hits the nail on the head. There's a lot of little nuances in here that just absolutely show the value in what we do and how we attack the markets. It's a very logical way, which sometimes logic is not exciting, but logical works. And you can see through this the power of what we do. And we've got hundreds of testimonials and comments like this. This is just a member's comment in our morning update, but we have lots of these, and it just shows the power of what we do. This is a very short-term indicator, could just pull back for a day or so. But let's dive into this interesting chart right here, which is the afternoon update that I shared, talking about how we've got the 30-minute chart down here, how stocks were bid higher in pre-market yesterday, and the market gaps higher. And what this does is it excites traders and investors, those who don't understand the markets and who are really just kind of jumping from news piece to news piece, analysis to analysis, and chasing pricing. The market makers gap the price up, get everybody excited. They create liquidity. Institutional players will make it move so people feel like they're missing out and they get in. This creates a lot of volume. They can then sell into that. Now we can take things a notch further and we can look at our custom FOMO indicator, which I show on the 30-minute chart here. More or less, this is really sucking people in. They're getting anxious. They're getting excited that stocks are rallying. They're putting in a move. And when we see this indicator spike over 3, we know the market is manipulated. We know it is emotional, and an emotional market is usually a turning point, and we're probably going to see selling, and that's exactly what we saw yesterday. And then if we zoom in a notch further, this is the 10-minute chart. We had the open, that the market opened higher. And you notice the big volume selling, that is institutions selling. They're dumping big waves of orders. They let the market drift higher with excited traders thinking, oh, it's just a quick pullback, and then they hammer it with more selling. These are institutional players lightening their portfolio. It's called distribution selling. And this is, even though the market's closed positive yesterday, the average investor thinks, oh, the market's strong, it's doing well, it's rebounding. But this is pure manipulation. We can see it from 3 different ways of how they're unloading shares and doing all that. And this is something I share. Obviously, many of you have read my book if you go to our website here, Asset Revesting. But this 30-minute chart and how to set up the overbought, oversold, the panic selling, the FOMO indicators, all in this book if you wanted to do that. Of course, we're waiting for that bounce in the market to continue to mature and unfold. And a lot of you are interested in learning more. We do have a couple courses on trading. So Trading Strategy Mastery, if you want to learn while we wait for more trade setups and so you can become more sophisticated and be really in the zone. Trading Strategy Mastery, this is a quick 3-hour course. This is if you have your own strategy for trading whatever it is you like to trade. And this is going to be a way for you to document that strategy so that you can hand it to anyone and they should be able to follow it. Now, the catch is, as you document your strategy and figure out all the rules and what works, you're going to realize your strategy doesn't actually work that well. It doesn't work very well most of the time. And that is how you end up building a good strategy. But this is a dream crusher, but it is critical. And the reason for that is if we go to these stages here and we go and we look down, there are multiple stages in this market. And of course, every stage, a different strategy is required. And You'll notice our ACS, OTS, and TTI strategies work into stage 3, which is what we are in. Although the TTI strategy has now come to an end, the long-term investment strategy has generated a sell signal. In fact, we go to the chart here. We have entered a new bear market phase. Again, this is understanding bull and bear market phases in the markets. We want to know when we are in a this is after COVID, a rising tide, or if we are in a falling tide environment. Of course, we've been in a nice rising tide, but now we are starting a falling tide. And of course, what's happened here in terms of the technicals is similar to what happened over here, except for this time around, the technicals are way worse, pointing to not just a little pullback and pause in the market, but more so a bigger crash and something pretty ugly. So my point is, you need to make sure when you do create a strategy that you know what times and what market conditions it works well in. Of course, these strategies, ACS and OTS, are options trading signals, and our adaptive compounding strategy, we automatically evolve the strategy and it changes. We change it for you as the market changes. So it's kind of done for you from that regard. And the trading as a business course, this is like to take business serious. It's not a gamble. It's not for fun and excitement. It's to grow your wealth. And if you treat it like a business and you manage those positions, then you can do very well. Both of these are very sobering. They're not that fun. I'm not selling them very well, but these are the core. Successful traders are disciplined. They're patient. And when you know what you're doing, trading actually does become pretty darn boring because we know when not to do something, like cash positions. We're waiting for setups, all of that stuff. And it's not a bad thing. It's just, trading, when you become really good, takes a lot of the excitement out of it because you kind of know what you're doing and you're following those strategies. All right, let's jump over to gold. Obviously, it has been on a tear. We are in that bullish environment for gold. We have been for a long time, ever since the new major bull signal in 2019. But if we stair step our way up, we have hit those major targets of 2750 and 2800 as our major. That was our 20-year and more or less like our 10-year cycles both hit that same level. And so now this is icing on the cake, as we've talked about, kind of a blow-off phase in gold. Everybody gets super excited, really bullish, and we tend to see a very strong move. And I do believe we're going to see some type of pause or pullback in price eventually, but it's starting to get that FOMO phase. We're actually starting to see gold miners actually jump on board and move higher, which is telling us people are getting really bullish. And it is pretty exciting to see gold start to move up. It is a warning that things could get ugly as well in the economy. Higher gold prices isn't usually the best economy going forward. So it's while it's good maybe on the pocketbook if you own physical gold or miners, it also means it's going to be a little crappier potentially from an economic and livable standpoint as things kind of fall apart. But let's take a look at the Fibonacci extensions. We've had a series of moves recently. This is the weekly chart. We can gauge based on the rally and this pullback. We have these moves. So the market has run up. Let me just draw on here. We've had the run up. We've had the pullback. Hit the 618. It paused. It came all the way up. Hit that 100% measured move. Now, again, when we're at a 20-year major cycle high and we've blown past it, all we can do is stair step our way up. I don't go by leaps and bounds and say, oh, we did 100% move, now it'll be 200%. I know a lot of people do that. It's easy to put huge price targets on gold, and I don't like to oversell on something because if you say big numbers, people, all rationality goes out of the window and they just take the gamble. But anyways, if we take a look at this next move here, we've got the rally up. We've got the pullback. We can take this gauge to where it should go. We've also seen this move, which means we've had the move up, we've had the pullback, and we've hit the 618, and we've more or less paused through here, and now we've gone up and we've hit that 100% measured move. Now, if we were to zoom in a little bit more, we can take a look at the next level here, and we've got this low, we've got this high, we've got this low. We'll carry this forward. And of course, we've hit this smaller move going forward. And then we can take another one based on the most recent price action, this rally up. Now, this is a weekly chart, so it doesn't show many bars. And we have this pullback, and we can carry this forward. And this is where we come to that 32.75 area, which is pretty much where we're at right now. I think we're going to see gold push up and test this level. That is the furthest we can gauge where gold is right now. So it's had a very nice move. Everybody's getting excited about it, and that's usually a sign that we're getting a little frothy short term. The trend is clearly up. Now, the big question people are saying, well, I'm long gold and miners for a trade. Where do I get out if this thing starts to reverse? So let's just take a quick look at the daily chart. And if we kind of go back and just, you know what, the weekly chart's probably easier. Let's just take a look at some of these recent moves, really in the past year or so. If we take a look at these moves, you can see gold has had some really big corrections. Now, this is a huge correction. That's actually many years back. You know what, we'll keep it focused on the most recent since this new bullish leg started. If we go into, we take a look at this, we can just go from the recent high down to the low. That was a 12% pullback. Here we had a 7% pullback. Here we had a 7%. Here we had a pretty decent one again, a 9%. And over here we had a pretty decent one last week, 7%. So if you just look at these average pullbacks along the way, they tend to be 7, 8, 9% on average. So you really do need to give it at least that much wiggle room to let it breathe. It's got to pause and shake things about. So more or less, I would probably be giving it that 8 or 9% wiggle room from the highs, if not a little bit more, potentially even under the 20-day. And I would probably leave it as a mental stop, just so you don't get run out. Gold's not the type of thing that's going to crash like 30% in a day. It's not like a lot of other assets, so you don't need to be, I think, quite as protective. It's more of a snail in terms of how it moves. But overall, I would be looking to potentially put that a stop about 8 or so percent below it, maybe below the 20-day moving average, and kind of go from there. Whichever one is lower is the one I would go with. The 20-day moving average will eventually move up, and it'll get a lot closer to price and can get pierced many times. Whereas if you keep a horizontal level that's always down about 9% or 10% from the high, you could do that. So it really depends on your trading strategy, but you do have to give it this much room. Every asset has different amounts of volatility, and volatility changes over time. But as you can see, gold can still fluctuate pretty easily within a 10% window every couple of weeks or every few months. It has that shakeout. So that's kind of how I would look at something there. All right, let's do the same with the weekly chart of gold miners. We had a low over here where the market came down. It obviously has turned a corner. It now has a series of higher lows and higher highs. Over here was a series of lower lows and lower highs, which is the definition of a downtrend. So if we take this, we can just gauge on this first run and the pullback of where gold miners should go. It came to the 618 and then pushed up and kind of popped and had a little blow off at the 100% move and then re-corrected. If we go forward to where we are now, we have this low, we have this previous run up, we've got this most recent pullback. Again, this is the weekly chart and where gold miners should go. So it is showing still some more upside from where we are. There's another about 3-4% to the upside before we hit a critical level where it's going to potentially run into some selling pressure and have some type of pause or pullback. So that's kind of where we are. Gold miners, silver miners. Gold miners are like that. Silver miners are a little different. They are, instead of pushing up and testing some highs, actually, I'm just going to go back to gold miners for 1 second. If we zoom back in time here, let's just go way back. We're definitely coming into, this is going to be right up into this peak and all these wick lows through here. So there's definitely going to be a major resistance pivot zone on this chart. If I draw a horizontal line, you can kind of get a visual of how prices has pierced through that a few times and then got hit under and poked through it, got hammered, and then traded through it and became support, broke through it, came up through it short term. These long-term lines can be pierced and broken all the time, but it's overall, do they resolve back under it or above it? So we're definitely coming up to that level. Silver miners like SILJ, pretty ugly chart. When we look at it long term, it really is kind of a series of lower highs, a series of higher lows. It's a pennant formation. It's building for something big. And I think that will come in due time. I think the big will be to the upside. But overall, the market is really still consolidating. And if we just go to the daily chart, actually, we'll stick with the weekly for a minute. But overall, it is coming up into resistance. Look at these highs. High, acted as support, held for support, then got stuck underneath it. So silver is coming up into resistance. Miners are about to hit their 100% measured move. Gold is at its 100% measured move. And I know everyone's bullish and they want really good, and they're feeling good. And just remember, when things feel really good and you're excited about something, it usually also means it's probably ready for a pause and a break, and it's ready to hurt your feelings a bit. That's the way the markets work. So just be aware. While these trends are up for all of these, they are now threatening some resistance areas and some levels where we'll start to see some pullbacks. All right, let's take a look at the 10-year note and the 30-year note. Take a look at these charts. Let's just zoom way back in time. Obviously, a falling trend for the last like 40 years, and now we've gone to this reversal, and more or less price is looking somewhat bullish here. Let's just use Fibonacci extension, and this is a touchy subject, but overall, if we look at the technicals, it is showing us that we should see like 8% yields here on the 10-year. That brings us right up to another significant peak, which brings us to this very significant level going way back into the 60s, 70s, 80s, all the way through. This is a huge pivot point. And this is, 8% interest rate is what I remember for some reason growing up as the norm, is that 6 or 7, 8% everywhere. So that is what the 10-year is showing. Peter Schiff talks about, rates should be going higher, but they're not. Inflation's going to go up. And who knows what the market is going to do, but there is the charts are pointing to a big move to the upside. Take a look at the 30-year yield as well. Let me just get rid of this spike over here. It has the same type of price action. Obviously, if yields are going to skyrocket, that means there's a lot of uncertainty, a lot of risk with the U.S., and that brings us back up to that pretty much the exact same level as the 10-year, 8.2% yield, which could mean, if that goes up, it's going to be pretty ugly and a pretty rough economy and things like that. But if rates go up or hold up in value, we could see bonds continue to fall. And if we look at the weekly chart of bonds, let me just clear this chart. It's pretty clear that we are still in a downtrend. I remember we got out right here at the open at the high on a 19% gain on a huge move up during COVID. And ever since then, it's been in this short-term topping phase, a long-term head and shoulders topping pattern, a stage 4 decline. Now it's trying to build a base, but it is still in a more or less a downtrend and in struggling. So bonds could have another leg down, another like 6, 7, 8% move to the downside potentially. So that is kind of the take of the charts. Anyway, long video today. I covered kind of a lot, but I wanted to go into some nitty gritty details and cover a bunch of stuff that a lot of you have been asking about and go from there. Anyways, that's it for now. Talk soon. Bye-bye.